You knew I was going to come to you first on this, because ahead of the print yesterday on this program, you said that if you did not own Disney here, you could buy it, and that was some 7% ago. So you got to own it.
Yep, I do. And I still think, just to use the phrase, you should own it still. And if you bought it yesterday, I'm sorry that it's down 7%. But I very strongly believe that over the years to come, this is going to be a better returner than the S&P 500 overall. So please don't be thrown from this horse by one day. What happened is they missed on the subscriber counts. And why that happened is because of Hotstar, the people who removed their Hotstar subscriptions. Hotstar is mainly their Indian subscription source. It's a low ARPU business. It's not where you're looking for the growth either in numbers or in revenue. So this doesn't really throw me from the belief that at 118 million subscribers, they will get to their 220, 240 million subscribers in 3 years. They're still projecting break even at that point on Disney Plus. And that's incredible given that they're going to ramp up their spending on content. That tells me that they're projecting better numbers ahead than they were just a year ago. And, you know, I think also with Disney, what you've got to remember is there is the theme park business, there is the studio business, both of which are coming back post-COVID. I know today's a lousy day. Some days the market punches me in the mouth. Today is one of those days. But by no means am I staying down on the mat with Disney. I'm back up. I'm in it. You should be in it, too.
The question is, Jim, are there longer-term issues that Disney of saturation point, and that the franchises, the great ones, of course, that they have, will only take them so far? And not only do they need to spend, as you say, but they need to spend a heck of a lot more money. Bernstein today is talking about that. MoffettNathanson says the company will now invest more on programming than their most recent estimate of $8 to $9 billion. That clearly is the focal point. Price target cuts today from J.P. Morgan, Goldman Sachs, UBS, Bank of America. Barclays does a victory lap as they downgraded the stock not all that long ago going into the number. So, Jim, how do you deal with those bigger picture issues, right? You blame it on one thing. But those are some serious issues that investors are going to have to grapple with. A, saturation, and B, a much bigger spend than maybe we were anticipating.
Yeah, it's a great question, Scott. You know, as you were asking that question behind you, they put up the march to 118 million subscribers from 10 million 2 years ago. And that just right there is a little breathtaking, 108 million over 2 years. Yeah, the growth rate is going to slow down because we're no longer in the pandemic. And yes, they are going to spend more. But however, I think that it's spending that you will see a very good return on investment from. That is the thesis for long holders like myself. You know, time will tell, but basically what I'm just one quarter. And it's a blip in the overall trend that the chart behind you when you were asking the question clearly shows is moving in the right direction. I think it will continue to do so. And just to summarize, that spending, that's good spending. That's spending that's going to have a good return on investment.